So my name is Frank Donati. I'm a CPA based out of our Denver office, partner in our transaction advisory practice. I focus 100% of my time on transaction advisory and financial due diligence. And Carolyn.
Hi there. My name is Carolyn Linkove. I'm in Eide Bailly's National Tax Office, and I focus 100% of my time on the taxation of anything having to do with anything corporate, restructuring, sale, disposition, and so forth. And I'll hand it off to Jason.
Yeah, and good morning and good afternoon, everyone. My name is Jason Vetter. I'm a colleague of Frank's inside the transaction advisory group at Eide Bailly. I focus specifically on sell-side brokerage, which is helping business owners, entrepreneurs, and management teams sell their businesses, all or a partial interest, or whatever strategic transaction they may be looking to go through. We will advise throughout that entire process to reach their goals and objectives. I've been with Eide Bailly for about 10 years now, and prior to that, I was in private company business valuation as well as public company stock research at a brokerage firm. And I'll be leading you through the first section of today's webinar. We'll be taking a review of current M&A market conditions. We'll take a review of recent trends in valuation multiples, as well as an assessment of current market conditions. As you've probably seen in the news, right now is very much live ammo with any piece of information that we get from the Fed, from an inflation report, from a jobs report. I mean, it's all factoring in very heavily into investors and companies' decision making. And then we'll talk about expectations based on what we know today and the information we have on what that could mean for the remainder of 2022 and beyond. To kick things off, though, let's take a trip down memory lane a little bit as far as overall U.S. M&A activity. I'd say on this graph, pay more attention to the yellow line, which is deal count and deals getting done, as opposed to aggregate deal value, which can be skewed by a large public company deal. Whatever Elon Musk decides to buy this quarter, if it's Twitter for $44 billion or someone else, that can skew that bottom chart. But the better pulse is really that yellow line as far as deals getting done. And so let's take a look back, starting in early 2020, just through COVID. For a brief moment. I was at a conference in March talking about deals with private equity investors and companies, trying to figure out if we're going to elbow bump or what's going on and what does the future hold. And it wasn't but a few weeks after that things really shut down in late March, early April 2020. And that's reflected here in the Q2 2020 deal count. You see that drop like a rock, and mainly the deals happening there were deals that were already on the first yard or the 1 yard line to get done, things that people had been working on through the end of 2019, looking to close. So some of those hung over, still got done, but for the most part, there was not a lot of activity in Q2 and Q3 of 2020. Lenders, leveraged finance groups at banks were very much focused on shoring up their own loan portfolio instead of making new loans to private equity groups or other investors to purchase businesses. So a lot of deals we had right in the middle of that took a pause for the summer, but came back very aggressively in Q3 and Q4 of 2020. And you see that reflected the accelerating pace all the way through the end of last year. We had a lot of clients approach us in the first half of 2021 and the second half of 2021, really worried about, a big hot topic was tax increases. Are we going to see capital gains taxes on the sale of a business increase all the way up to ordinary? And that's almost a doubling of the tax rate on a sale of a business. And a lot of business owners contemplating selling, that was a big accelerating factor for them, is not wanting to roll the dice into 2022 and what the tax environment could be. So a lot of deals happening end of 2021. Ultimately, though, with everything going on in Washington, does not look like that aggressive of a tax policy is really coming to fruition. for the first 2 quarters of 2022, we still saw propped up deal making in line and above pre-pandemic levels. If you're looking at 2017, 2018, 2019, we're still above that. We're still seeing a lot of activity in the market right now going through. So overall, as we're seeing the data today, first half of 2022 still was a very robust deal-making environment. Jumping from overall to specifically private equity, saw a lot of the same dynamics there with private equity groups. A huge spike at the end of 2021 for them doing deals, acquiring companies. There was that drop there, the first quarter in 2022 and second as well. But a lot of that is a bit of the deal hangover from the very robust activity in Q4. I know as we had new opportunities to share with private equity groups, a lot of them were saying, we don't have the bandwidth to review new opportunities. We need to close the deals that we have on our plate right now, with owners really motivated to execute and finalize those transactions by year end. So a lot of the new deals that we had available for them, they said, we're probably not going to get to looking at them until early 2022. So that kind of plays into it, in that a deal process a lot of times takes anywhere from 3 to 6 months to execute. And if everyone is looking to get things done by the end of 2021, there can be a lag sometimes with people refilling their pipelines and executing deals on that timeline. It pushes things out towards the middle of this year for deals post 2021 as they look to execute. But overall, still very robust activity amongst private equity groups, and looking to see that continue as they refill their pipelines here. And jumping forward to just fundraising, keeping on the topic of private equity, as we got through 2020, the first graph on the top right, there was a lot of new funds that were formed and came to market, a lot of capital that came to invest inside of businesses as people look to redirect their capital on where do we invest, where's that market opportunity. The public markets went on quite the run from reaching a bottom in April 2020 through the end of last year, which spurred a lot of investment appetite into acquiring businesses. Looking in the bottom right, as we think about unrealized value, which is active capital tied up in operating businesses, not yet realized through selling them at a future date. Capital invested there is high, as well as dry powder, which is a key indicator for us as we look at how much capital does private equity groups have at their disposal. It's unspent capital from limited partners and other investors into their funds. How much do they have of that available to deploy into acquiring other businesses? And that remains at an all-time high with capital acquired through 2021. So it remains very robust. And we kind of talk about where's activity today. Here's some more specifics on fundraising in the top right of this slide. That yellow line talks about capital being raised up there, which continues from Q4 to Q1 2022, Q2 2022. It's still going up. Some of the funds that are closed as a result may have been down, but the amount of capital that can be deployed to acquiring businesses still remains at elevated levels. We kind of see that as a precursor or an indicator that private equity groups are still going to have an appetite to acquire companies and businesses going forward from today. A lot of that capital comes with conditions for private equity groups. An investor says, hey, I'm going to give you some capital and I expect that to be deployed within a specified amount of time, or I can call it back or return it and put it somewhere else where it is actively being used. So private equity groups are motivated to get deals done with the capital that they have raised. So we see that as a a good indicator right now, a leading indicator, if you will, on activity to come. Breakdown of fundraising by type still remains pretty typical. Buyout, private equity groups looking to acquire a majority of a public company, not a public company, a private company, an operating company, still remains the predominant transaction type in the marketplace. Growth equity, if you will, investors looking to deploy a level, could be a minority investment to help the company invest in working capital and inventory, whatever that may be, to grow their business if it's a fast-growing enterprise, remains the other predominant source. So not too much of a change in the type of fundraising, which tells us there's still appetite for transactions comparable to what we've seen here to date and historic. Now, jumping forward to valuation multiples and trends. Through year to date, with the activity we've seen, there hasn't been any drastic pullback in multiples. We've all probably seen the public company investment and pricing environment right now reaching the highs at the beginning of 2022, and market caps and share prices have come down over the first half of the year here. As it relates to private businesses and acquisition multiples, we still see multiples in line so far with 2021 activity. We'll say with that though, a lot of those deals are ones that were probably negotiated the end of 2021 or early 2022, before this market slide, where LOIs had already been executed, valuations established, and then you look to go through diligence and close. So that there's a consideration there in interpreting this data, that some of these closings, Q1 and Q2, were the result of previous negotiations closer to the turn of the new year into 2022. So that plays a factor into it. But nonetheless, we're still seeing in our own practice, valuation multiples hold true, specific to businesses and the dynamics that they're seeing in terms of sales activity and profitability. But by and large, pound for pound, we are still seeing valuations hold steady, which is positive. So let's wrap all this up where we are today. What does that mean for market conditions? As I mentioned, economic data remains at the forefront. What's happening with inflation? What's happening with the labor market? And how is that going to inform what the Federal Reserve is going to do in terms of interest rate hikes and things like that? Inflation has been running hot. The market's been very on edge with regards to how that data is impacting the markets and how the Fed is reacting to it. At the same time, the jobs data that came out on Friday was extremely robust, which has really been propping up the market and the economy in terms of indicators we're watching. You might see headlines that say Google slowing hiring or Airbnb is doing something. Those big companies experience dynamics quite a bit different than what I would call the private sector, lower middle market businesses. There's still very much a high demand for talent amongst our clients, very much hiring people looking to grow their businesses. So there is still I wouldn't say a disconnect, but we're still seeing a very robust environment amongst private businesses that we deal with, less than $1 billion of value that we advise. So, and also most recently, the inflation report came out the other day that shows there may be some softening of the red hot inflation we've seen. The market reacted very positively, up a pretty good amount yesterday. And last time I looked, I think the market was up a little bit today on the heels of that. But again, another glimmer of hope here in that all this fear of running hot inflation what could a recession be like, or how bad could a recession be? Is there going to be a recession? Hopefully we saw a little bit of light in this most recent economic data, but we'll see. Also, for thinking about positive elements, I talked about private equity fundraising. Dry powder remains very high. Corporate cash balances as well, very flush with the positive sales activity that we've seen. We've seen a lot of deals here recently funded from public companies with cash as opposed to their shares. And often we see that as an indication they feel that their shares are undervalued. And we've seen that a little bit with the slide here, the first half of the year. A lot of share prices have come down, and private companies are using cash. I mean, if they bought a company today just using shares, and let's say the company doubled by the end of the year here, they effectively paid twice as much when following their share price. So a lot of companies are looking to use their flush cash balances, being that if they expect their shares to rebound here, is maybe we get a bottom and get some support here in the public markets with share prices. They want to avoid overpaying. So positive activity there. Now, with inflation and everything, what negatives could that present? Higher inflation and interest rates, those factor into a lot of valuation methods companies and private equity groups use. A discounted cash flow model is a huge approach that they use, discounting future profits back to the present as an indicator of what a company's worth. Well, if inflation and thereby interest rates are higher, and the discount rates that investors are using to discount those future profits back to the present are higher, that's going to lower the implied value of a business. And that's providing some constraints here on how aggressive private equity groups are looking to get. Everyone's watching consumer sentiment as well. We've seen the high gas prices, the high food prices, and that's impacting how consumers are spending and how they're reacting to that. Target, Walmart released some concerns over the retail environment and how consumers are stretching their budgets and allocating their budgets, and what could that mean? And overall, consumer spending in the latest activity still is supportive of environments, even though the sentiment is still a bit TBD. And we all lastly know about Ukraine and the shocks that could provide if there's any developments with Ukraine or Russia, grain exports, energy, things around those elements. We don't know what could happen next. We don't have a crystal ball, and ultimately those things are a bit TBD. But boiling this down into key macro trends we're seeing, like I said, strategic buyers, they're flush with cash. They're still looking to do deals that make sense. From our conversations with groups, are they looking to, let's say they're a California-based business, thinking about, hey, we'd like to move into the Salt Lake City market, make a play on that. Are they as motivated right now to make a new play into a new market right now? Maybe not, but if there's a complementary acquisition that they feel confident and comfortable that makes strategic rationale and they're not putting their necks out there too far, we've seen they're very much going to pursue it. That roll-up strategy amongst private equity groups too, that remains very much in play and in an active investment thesis that we're seeing. And also with private equity as it relates to more platforms, not a roll-up of businesses in their existing platform, but new platforms they're looking to make. We're seeing that there was a modest decrease in activity, but again, I talk about that Q4 hangover from last year. Got to consider that in terms of private equity groups assessing the acquisitions that they did make around the new year, and also refilling their pipelines. But as I had conversations last week at an event with private equity groups, they're still assessing which groups performed well throughout COVID. It didn't drop too drastically in 2020. And also a lot of companies performed very well in 2021. And how likely is that to continue? There's some businesses where 2021 was their best year ever. maybe their backlogs are still strong today, but they're starting to come back down from new bookings slowing a little bit. It's still sustaining 2022, but what does that mean for 2023? And buyers are buying the future, and they're going to be intimately assessing what that future holds for those businesses, and how that impacts their interest in it, and also their valuation levels based on future activities. I mentioned interest rates and that discounted cash flow valuation. Well, that's playing a factor into leverage deals and what people are willing to pay. The interest rates on debt that they're taking on to acquire those businesses, that's all playing a factor into if and at what valuation levels deals are getting done. And like mortgages right now, if you're trying to buy a new house, it's getting a bit more expensive. Still overall, not at ludicrous rates or anything, but it's playing a factor in here into the pricing of deals for private equity groups and companies alike. But nonetheless, we're seeing a lot of capital. Cash balances are flush. Dry powder with private equity, they need to deploy that capital. It's still remaining a competitive environment overall. So to the polling question that I have for everyone here, what are your expectations for overall M&A valuations and deal multiples in 22 and beyond compared to 2021? Do you think we're going to see an increase significantly, moderately? Is it going to be unchanged, or a decrease? Where do you think it's going to be? All right, well, very good. 11% significant increase, 40% moderate, 25% unchanged, and 23% decrease. So that's basically 50% think unchanged or decrease, majority of moderate and some significant. Interesting breakdown. Well, let's compare those polling answers to a survey in Q1 2022 of corporate development professionals. And what did they say on their expectations? And here's the breakdown. Really, it's about 2/3 think it's going to be unchanged or a decrease, 31% moderate increase, 6% significant increase. It's an interesting dynamic here. Pretty much 50% remaining in that unchanged camp. Similar to those multiples I shared at the beginning or earlier in this presentation, where they were pretty much flat for the first half of the year versus 2021. It still remains how the Fed's reactions, how inflation, how the jobs report, and the economy as a whole goes from here. But it does seem like centering in and around that unchanged is sort of that bell curve right now. We'll see what data comes out and how the market reacts, whether that leans more to the increase side of the coin or potentially a decrease. But finally, what are our expectations? What are we seeing in the market for 2022 and beyond? Overall, we see activity continuing to be at a strong level. We're probably not going to see 2021 levels, especially in Q4 going forward. But as we look at 2017, 2018, 2019, the activity we saw there, with the amount of cash companies have, the amount of dry powder that's out there, we still feel there's going to be elevated acquisition activity. As far as what a recession, the probability of one, what it could mean for the markets, obviously everyone's watching that and following the data on what that could mean. As I mentioned, companies are looking to pursue plays for the most part that make a ton of sense, they're confident in, they're very complementary. But are they looking to make a huge play or a huge bet right now? That's probably in the minority of strategies versus the majority, given where the market's at and the uneasiness and the geopolitical shocks from Ukraine and what that could mean. Overall, though, we still see that M&A activity remain strong. We think valuations still remain supportable at levels we've seen, but you need to assess your own business on where have I been over the past 2 years and where do I look like I'm going to be going from here. If someone has a business where 2021 was the highest year ever, markedly above anything they've done in the past, The backlog for 22 maybe is still supported at levels close to that, but new bookings are starting to trail off. Companies and investors are sophisticated, and they're going to try and understand what's the run rate level of this business going forward. Are we going to look at more of an average performance over the last 3 to 5 years through COVID, thinking we could return, or this business could return to 2019, 2018 levels? Or have they invested to support 2021 growth levels to continue to find business above levels they could have achieved in 2019 and earlier? They have a bigger employee base, more capital, more equipment to go after more business, and therefore we can still sustain above previous levels. All those are conversations in terms of structuring, and I talk about what's future levels of a person's business and sales versus historical. That's where creative structuring could come into play. We talk about earnouts. They may say, hey, we're willing to buy this business based on a 3 or 5 year average of earnings, but we're willing to have an earnout to bridge the gap to maybe what your 2021 earnings and a multiple of that, whatever that valuation would indicate. We're willing to bridge that and pay for it so long as you achieve similar results through the end of 2022 or maybe the end of 2023. Creativity like that to bridge valuation gaps, trying to protect the investor, yet if the business does what the seller and the management team says it's going to do, still allow for that. So all those are factors. The economy, where businesses are going forward, no one has a perfect crystal ball, but everyone's trying to be prudent. There's still investment theses and motivation out there to do deals amongst companies and investor groups, but it still is an evolving conversation ultimately on how deals get done, the valuation and the structuring of those therein. That's my section for today. Hopefully that was insightful on the past and future of where we might be headed. New data coming out daily and next week will help guide us and inform us where we're going. But from there, I will hand it off to Carolyn.
Thanks, Jason. That was very interesting. I appreciate that. Just to reintroduce myself for those who weren't here at the beginning, I'm Carolyn Linkove. I'm in Eide Bailly's National Tax Office. My work and the following few words that I'm going to talk about focuses on the taxation of various kinds of corporate transactions, shareholder level issues, and so forth. So this is just really about the taxation aspect of transactions. So what I'm going to talk about in the next few slides is sort of what I think of as my greatest hits. Not my greatest hits, but the greatest hits, I would say, from the past year or so of my practice. And so I'm going to maybe talk about some things that I see with S corporation planning for deals, C corps, and so forth. And so my hope is that at the end of my time here, something I talk about will resonate with you. Maybe you've had an idea for your own company or for your own client. You weren't sure if it works or what other people are doing in similar situations, or maybe I can introduce to you a new planning idea. So hopefully that's what these next few minutes will bring to you. So many of Eide Bailly's clients anyway are S corporations. And as Jason was mentioning, these are, generally companies in the middle, what we call sort of middle market clients. One, and this isn't a novel thing, but I've just happened to have seen it a number of times recently. So there's a provision in the S Corp rules where if a selling shareholder, even whether they're selling a portion of their stock, which has to constitute at least 20% of the outstanding stock of the corporation, or if all of the current shareholders are selling, there's an election that can be made to sort of terminate the S taxable year artificially. You're not actually terminating it. There won't be two S corporations filed. But the idea is that is that we can treat the tax years ending when the shareholder or shareholders dispose of their stock, so that if maybe during the part of the year, if say the shareholder disposes of her stock on June 30th, and from 1/1 to June 30th, the S corporation showed a lot of taxable income, well, maybe it behooves the selling shareholder to have all of that income allocated to her. Maybe she has suspended losses that if she doesn't use now, she will never get to use. And so maybe, and while the other shareholders have to consent, they may say, fine, you get all the income. And then once you're out of the picture, we will allocate the S corporation income ratably among us for the rest of the period of time. So in any case, it's something that's been around. It's not novel, but it can be useful when we have insight into different shareholders' tax situations, and it could be, something to negotiate with their fellow shareholders. And then actually at the bottom of the slide, it talks about the 20% qualifying disposition election. That really should have gone on the prior slide. And again, that just goes to who can make that sort of terminating, that sort of closing of the books election. And this one just goes to, if only 20% of the outstanding stock of the corporation is disposed of, you have to do this one. And the other terminating election applies when a shareholder's entire interest is disposed of. So moving on, the F-reorg continues to be the reorganization or the transaction du jour or du year. I know I've been seeing these constantly in my practice. And just to refresh, some people have heard the term but aren't exactly sure what it's about. And it seems scary, but it's very benign. So an F-reorg, at least in the context of transactions with S corporations, is a preparatory transaction that the S corp shareholders do in anticipation of an actual sale of their stock. And basically, it's done so that prior to the sale to the buyer, the shareholders own directly shares in a holding company. And that holding company now owns what had been the legacy operating S corporation, which becomes a Q sub, which is also a disregarded entity. And that's the whole reorg. And to get to that structure, it's a tax-free transaction. And buyers typically ask sellers or S corporation shareholders to do that, because the end result of that structure, where it's shareholder, holdco, and then operating company underneath it, allows the buyer to treat the purchase of the stock of the legacy operating company as an asset purchase. So it's almost identical, pretty much is identical to a 338H10 election, and that it tends to be, from a tax perspective anyway, buyer tax favorable. It's just achieved, instead of via this election, via doing some sort of pre-structuring work. Why I get this question, well, why would I do an F-reorg if I can just do the 338H10 election? One significant reason is for 338H10 elections, aside from the fact that you need to have the right kind of buyer, meaning you have to be a corporation, and the right, the other thing is the buyer has to be acquiring at least 80% of the equity of the target. In instances where the buyer doesn't quite want that much, because for instance, we have buyers that say, I'm willing to purchase whatever, 70% of the equity, but I want the, some of the current management to roll over some of it. I want to make sure they still have skin in the game. So if they were to wanting to buy less than 80%, the transaction wouldn't qualify as a 330H10. And that's why they would do the F-reorg, because the buyer can acquire any amount of stock, any percentage of the stock. But again, the buyers get the basis step up with respect to the percentage of stock acquired. To that point, while sort of the F reorg has now, I wouldn't say it's lost its luster, but it's no longer novel. One thing I have seen in the past few months is how the F reorg is achieved. If you're a tax dork like I am, it's kind of exciting. So the traditional F reorg is where I alluded to, the buyers form a holdco, contribute their S corporation stock to the holdco in exchange for holdco stock. Well, sometimes, because in order to do that, each S corporation shareholder has to be willing to contribute his or her stock, has to be around, available. You have to be able to rein them in so that all the shareholders can do this contribution essentially at the same time. I mean, it's basically just signing a few pieces of paper. Well, when that's going to be just difficult, maybe you have an S corp with, I don't know, 60 shareholders. The same result can be achieved where you're set up in the right situation for, immediately before the sale to the buyer. But basically what you, instead of doing it through an individual shareholder contribution of his stock to holdco, you basically achieve it through a merger of a merger sub into the company, and then there's a holdco and so forth. So it's called a merger F reorg. Same idea, just a little bit different how to achieve it, and it's just done for administrative purposes if it's going to be too hard to lasso in all the shareholders. So a couple greatest hits I've seen, or I just wanted to raise about standalone C corps. One planning idea, and again, this isn't necessarily in structuring the transaction, but just what can you do if you've purchased a C corp? So in the first bullet I have this has to do with NOLs, and so this play assumes we're not in a 382 position. And I know it would be hard to assume you don't have a 382 limitation if you've just acquired a corporation. But in general, as you may know, the Tax Cuts and Jobs Act said, indefinitely, whatever NOL you have can only offset up to 80% of a corporation's taxable income. And so one thing that could be done is, if you have if a corporation has the opportunity to have a deduction, to defer a deduction to a later year, that may behoove them where they have lots of NOLs to use, because if they kept the deduction in the current year, they would have lower taxable income, and therefore they would have less, and so 80% of less taxable income means less NOL. And so maybe you can defer the deduction to the later year, where then you could have more taxable income to absorb your NOL. Another sort of C Corp greatest hits is allocating purchase price, or at least a portion of it, to personal goodwill. Some of you are familiar with the Martin ice cream case. The significance of this sort of play is that if you have a C corporation doing an actual asset sale, or I suppose a deemed asset sale, one of the items a buyer is, I think, always buying is what's called, the goodwill of the corporation. Well, the Martin ice cream case is a case that really stands for the proposition that, gee, sometimes when a corporation says it has the goodwill, it's actually really the goodwill of its owner. And the reason why people want to do that is if that means it's the owner, the individual selling that asset, not the corporation, because we know that when a corporation sells an asset, it subjects the asset to 2 levels of tax. So if you can make the argument that whatever goodwill the buyer is buying is really because or result or is emanating from the shareholder, you have a way to sort of subject that portion of the purchase price to only one level of taxation because it's coming from a sale of the individual. So it doesn't work in all situations. You have to have a terrific fact pattern to support it, but it could be a pretty big tax saver if you have the right set of facts. And not related to that really, but just in the context of C corporations, nothing new. But in the consolidated return realm, when a consolidated group acquires a corporation, the general rule is that the target's taxable year is, or they're deemed to join the taxable group at the end of the day on which it's acquired. Well, there's an exception called the next day rule. And this rule says, for certain extraordinary items, you can treat the target as joining the consolidated group essentially the day after it's acquired. And why is this important? Well, suppose target may have an extraordinary item, well, related to the transaction. Maybe it's going to pay severance costs or a bonus or some significant item. Well, if that item was allocated to the target under the normal same day rule, it would be that item would get deducted in the hands of the old owner or the current owners of the target. Whereas if we can defer that deduction to the next day, when the target is officially a member of the group, well, now that deduction becomes a deduction to the buying consolidated group. Again, this isn't a novel thing. It's just something that I continue to see, and it's a way, it certainly is a negotiating tool. Moving on to a couple other consolidated group opportunities. The consolidated rules are just voluminous, and we don't see them that often. We don't have a ton of consolidated groups in the Eid Bailey practice, but just because there's been so many consolidations and transactions the past couple of years, we have seen an increase in the number. And so the more consolidated group work you do, sort of the more rules you become aware of that heretofore we're hiding under the thousands and thousands of pages of regulations. And so, this purpose is just to highlight a couple of these sort of potentially beneficial rules. One is an election the acquirer can make if the target has NOLs that at the time of acquisition will either are anticipated to go unused or they're going to expire. The buying group can make an election to basically make those NOLs disappear as if they disappeared immediately before the group acquired the target. Why? Because among the regime in the consolidated group rules is if the acquiring group was viewed as inheriting those NOLs from the target, the buying group would have to reduce its basis in the target. It would have a negative basis adjustment. And that kind of would stink if you both had to make a negative basis adjustment and then have an item for a tax attribute that you're actually never going to get to use. So I would spend more time on these slides, but I think I'm running out of time. So I just want to, you guys will get these slides, and if anyone wants to talk to me in more detail, we can. Transaction costs, whether the client, the target, the acquirer, whoever you're representing is the buyer, the acquirer, that's always a big area of opportunity. For book purposes, transaction type of costs, and I mean, the fees that a buyer or target or shareholder pays the attorneys, the accountants, the PR people, those are the transaction costs I'm talking about. For GAAP purposes, they often get capitalized. For tax, we often can find buckets of costs that we can pull out and deduct as current business expenses. And so those are always important areas to look at, especially after, say, you're the buyer and you've just spent a ton of money and you're looking to reduce your tax bill. This is a great way to do it. And then the covered transaction consideration is the 70% safe harbor. And what that is an opportunity if either the acquirer or the target pays a success-based fee, which is those lump sum fees you pay to an investment banker. There's IRS guidance now which says you get a blanket safe harbor 70% deduction for that amount. But I wanted to just call attention to this this issue because what I see a lot in my practice is the assumption that every kind of transaction is eligible for the safe harbor, and it's not. You have to be what's called a covered transaction, and a covered transaction is one of three. They're in the regs, but just the takeaway is don't assume just because your client paid a success-based fee that you can automatically use the 70% safe harbor. And like I said, I'm running out of time, so I'm just gonna I wanted to have these slides on here just because missed due dates in the 336E and 338H10 context are very, very common because it gets to be very confusing about who's the old target, who's new, did someone go out of existence, what happens if the S election terminates and so forth. So that's just something to be aware of, that those due dates really, really have to be not only nailed down, but attended to, because the missed due date for any of these transactions could basically invalidate the whole transaction. Finally, I just want to put in a message to, make sure whether you're a lawyer or you're working at the CPA firm, that throughout from day one of the transaction that there's coordination and that there's translation between the two sides, because whatever gets executed or drawn up by the lawyer then has to be implemented by the tax advisor. And so if the tax advisor doesn't know that something happened or doesn't understand what happened, the lawyer's work is for naught. And again, we could be in a place where the transaction doesn't actually get implemented or affected as our clients anticipated. So that's all I have for today. And please reach out to me. Sorry that I'm out of town. I am out of town, but then I'm out of time. So I'm going to hand it over to Frank now, and he's going to discuss some non-tax things again.
Thanks, Carolyn. Just to reintroduce myself, my name is Frank Donati. I'm a partner in our transaction advisory practice. I focus my entire time on financial due diligence and quality of earnings work, and then network and capital considerations. So that's what I wanted to take some time to talk about today, seeing just kind of the overview of what financial due diligence looks at, but also some of the trends we're seeing over the last year. All right, so seller considerations, I'll move through these a little quicker, but what differentiates us from an audit is we are really looking for what it could be rather than what it was. And when I say that, to Jason's point, how does the run rate compare when they're buying into the future? So certain areas we're looking at when we're helping a seller get ready to go to the market is one-time expenses and normalizations. As an extreme, is there a warehouse fire that impacted operations that is a once in a while occurrence, hopefully once in a lifetime occurrence? How did that impact your EBITDA? Then we're also looking at working capital and cash flow management. And we'll talk about that a little bit later with some of the constraints hitting the market these days and how this is a relevant conversation. Then we have discretionary expenses and market rate compensation or rent. Obviously, close hold businesses tend to have certain discretionary expenses from the owner that might not be relevant to the go forward operations of the business, or there might be related party real estate that is part of the transaction negotiations. And then last, we have post-close management technology, and this is more qualitative in nature. What are we seeing? What can we advise the seller to be ready for when they go to market? What a buyer may ask. Then similarly on the buy side considerations, very comparable to sell side, but a little bit more in depth when it comes to concentration risks. And what I'm referring to there is customer concentration or vendor concentrations that can significantly impact future operations should there be a cessation of that relationship for one reason or another. We're also looking at backlog sales and purchase commitments. What's coming down the pipeline? Does the pipeline look as strong as it may have done the last couple of years that led to the EBITDA growth that maybe people have been looking at over time? And then stock and asset purchases, really this falls into where Carolyn can help most, but can we identify what's favorable for the buyer in that case? Stock purchase, I would recommend there be some tax diligence as the tax liabilities would likely carry over. And then technology assessment, this is far from a very technical assessment of the technology, but are we noticing issues when we're going into the ERP system we should be aware of, or let the buyers know there could be some cost upcoming to modernize systems or make them more efficient. Some sample adjustments, and I'll go through this fairly quickly, but we really break them into 2 or 3 buckets. There's gap adjustments that are easily defensible in market. And then we have our diligence adjustment where you're seeing the adjusted normalized EBITDA. And then last, we have pro forma adjustments, which have become more and more common with COVID, trying to estimate what historical was, maybe without actual fact. Gap adjustment you'll see here, what we're really trying to do is turn this period that we're looking at to more of an apples to apples basis. In this case, adjustment 1, I'd point to inventory recognition changed during the period. It created an artificial pickup of EBITDA that we were trying to make sure we normalized over time, so it's not like you're looking at an apple and an orange. And then down in the normalized EBITDA, common issues here are deal expenses or those related party or closely held entity type expenses I was referring to earlier, and the one-time normalizations that you see. So some of the trends we're seeing as of the last year in quality of earnings, we're seeing more interest in sell side preparation. I would say our practice started out 5 years ago, primarily on the buy side. We've seen an industry trend towards sellers getting ready to go to market, so they're not blindsided when they get into market. So kind of having a heads up, and if there is some big issues, we can get to the bottom of them before going to market. Time is a deal killer, so trying to have the most efficient process as possible is always helpful, and that's where we've seen sell side preparation come in most handy. With that, supply chain and labor force impacts, certainly we're all aware of what's going on there, and I'll talk about them in a little more detail, but to give them context and how they're affecting EBITDA and working capital. And then last, we're certainly past, I would say, the period of economic woes from COVID, but there is still some impacts trending in the current year that stem from that, and then leading into the supply chain and labor force impacts. So really what we're trying to do with our clients is try and better understand year-over-year comparability as best as we can. And as for that COVID specific impacts we've seen, so historically what we would have done is typically recommend about a 3-year period of analysis. With COVID now having hit mainly in that March, April, May of 2020 time period, we're still recommending everyone do their quality of earnings or financial due diligence back to 2019, just to see a period that wasn't impacted as directly with COVID. So in looking at 19, 21, and 22, some of the items we're looking for is any earnings, sales spikes, dips due to COVID, either during that March through May time period in 2020, and then subsequent whiplash effect that we've talked about with our clients, where pent-up demand led to sales maybe in later 2020 that we've noticed in 21 or 22 no longer exist. Sale of non-traditional products or excess sales. People got very creative during COVID, as we all know. We had a client who went into the hand sanitizer business temporarily. Obviously, that is not a go-forward product from them that they will make nearly as much in sales as they did during that time period. So normalizing that out. And then these last two are a little more difficult to quantify, but deficiency in travel expenses, obviously with travel halting during the COVID pandemic, we are starting to see some companies get back to levels they were at in 2019. And then other targets that can say definitively, no, we've cut out travel, cut that cost out, and we've still been able to operate and grow from that. And then last, we have the expenses to adapt to remote environments. This certainly has gone both directions on EBITDA. We've seen floor plan leases go down, maybe locations close down as they transition to a hybrid model, but there's also been some cost as they go to hybrid model, whether it's in technology or just the general setup hardware that's needed by client or by their staff to continue to operate efficiently. So EBITDAC, I'm not sure if anybody's heard of that term, and I'll kind of fly through this tab as it is getting a bit dated, but this is what I was talking about earlier, looking for the pops and drops and some of the whiplash effect you'll see here. We had a client who actually had quite a bit in sales. Sales then declined during 2020, and the pop in December turned out to be some of the decline that we witnessed here hitting in that period. You know, the extreme example here would be some of it still floating into 2021 and trying to get to the bottom of whether it's a temporary increase in sales or if that's a sustainable run rate. Net working capital, I did want to make sure we spend some time talking about this as we talk about some trending of the supply and labor constraints. Over time, we have seen net working capital, in this case, stay relatively consistent, but you will see the gross values on the assets and liabilities going down, especially as people struggle to purchase appropriate inventories. So as we think about trending towards working capital targets of 6 to 12 months, something to be very mindful about not addressing in the 11th hour as you sit at the deal table, but getting out in front of understanding where net working capital has trended over the last 6 to 12 months. As you set that target can be very important, and not just looking at the last 4 years over time. I know we're running pretty short on time, but I did want to spend a quick second on this. I know Jason kind of addressed it at this point, but we are seeing more creative deal structures getting into play, kind of the case where less exclusivity, we are seeing retrades as people do their diligence, earn out sellers notes, rollover equity to incentivize hitting those targets that sellers are promising, and just in general being more creative with how purchase agreements are worded to get the deal across the finish line. And with that, I think we have our last polling question. So which item is not a deal point for which the QV can help facilitate?
Just for that poll, we are sitting about 40% say final selling price.
That is correct. We do not determine a final selling price. We team with Jason and the investment bankers typically on a deal, as there is just EBITDA is one metric to help decide purchase price.